Understanding futures contracts. Trading and accounting for future contract transactions in the market. Futures contracts are financial instruments that allow two parties to agree on the purchase or sale of an asset at a specific price and date in the future. Futures contracts are traded on exchanges and are used by investors and businesses to hedge against future price fluctuations of assets such as commodities, currencies, and stocks. When a futures contract is traded, the parties involved must make certain journal entries to reflect the transaction on their balance sheets. For example, let's say that a company enters into a futures contract to purchase oil at $60 per barrel in 3 months' time. The entry on the balance sheet for this transaction would be 1. An increase in the asset futures contract by the value of the contract, for example, $6,000 if the contract is for 100 barrels of oil. 2. An increase in the liability margin account by the amount of initial margin required by the exchange, usually a small percentage of the total contract value. 3. A decrease in cash or increase in accounts payable for the amount of initial margin paid to the exchange. As the value of the futures contract fluctuates over time, the parties may need to make additional margin payments to maintain their positions. These margin payments would be reflected as increases or decreases in the margin account on the balance sheet. When the futures contract is settled, either by delivery of the underlying asset or by cash settlement, the journal entries on the balance sheet would reflect the final transaction. For example, if the company took delivery of the oil at $60 per barrel, the entry would be 1. A decrease in the asset futures contract by the value of the contract. 2. An increase in the asset inventory for the value of the oil received. 3. A decrease in cash or increase in accounts payable for the amount paid to settle the contract. Overall, futures contracts can have an impact on the balance sheet of both parties involved in the transaction. The party holding a long position in the futures contract would record an asset on their balance sheet, while the party holding a short position would record a liability. Any changes in the value of the contract would be reflected in these accounts, and margin payments would be recorded in a separate margin account.